Welcome to the latest Motley Fool scoreboard. I'm on in Chock-a-Balloon. We've got longtime fools Matt Frankel and Travis Hoyam giving a 1 to 10 rating to the company behind tons of restaurant concepts, including my favorite special occasion steak chain, Capital Grille. It's Darden Restaurants, ticker symbol DRI. Talk about the business first, including factors like industry and competition. A 10 is invincible, a 1 is hopeless. Matt's at a 5, Travis is at a 6.
Yeah, kind of middle of the road here for both of us. I think we're kind of in agreement that the restaurant business is a nice business if you can have kind of the right brands. Darden's got some pretty good businesses, Ruth's Chris Steakhouse, Olive Garden, which I know has been a topic on Motley Fool shows, especially the podcast, for over a decade probably at this point. But the returns are pretty pedestrian. The return on assets that they have is about 8.8%. So decent business, but not a phenomenal business. Not going to be one of those massive outperformers, I don't think. So kind of middle of the road for both of us.
Yeah, and I mean, you mentioned the 8.8% return on assets. That's pretty good for a restaurant. The average successful restaurant, meaning that it's been in business for more than a year, has a net margin of about 5%. So it's a cyclical business that has low margins when things are going well. There's a lot of factors out of their control. Like, I don't know if you remember a few years ago after COVID, there was a chicken wing shortage that drove prices up for restaurants. There's a lot of things like food costs that are really out of their control, in addition to just economic headwinds. So it's a tricky business to be really good at. But as far as that goes, Darden's pretty good at it. So I gave it a 5.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you have 6s, Travis.
Yeah, the management team has been there for a while, so I think there's not a lot to critique here, and especially across all these brands, it's really hard to. I think it's hard to judge if the management team is doing a phenomenal job, because you're not going to see. It's not like Chipotle, right, where you're going to see changes across thousands of restaurants. There's so many different brands across so many different restaurants that you just see this big swath. So kind of middle of the road again. And I know that's kind of punting, but that's the way I feel about the management team.
Yeah, Travis is right. Their CEO is good, but he's not Brian Nickel. This is not that situation. But I do respect CEOs who really work their way up the ranks. As Travis knows, that's one of my favorite things about Mary Barra at GM. Rick Cardenas, he started as a busser in one of the restaurants 35 years ago and really worked his way up the ranks. And I mean, he's only been CEO since May of 2022, but since he took over, he's beaten the stock's beaten the S&P by 18 percentage points. So you can't really ding him for that. But again, not a big innovator or big transformer like a Brian Nickel type.
I will say in the notes, Travis, for his 6 on management, he says acceptable, just like the breadsticks at Olive Garden. I don't know why you didn't say that one, Travis. And you know what? I've been there recently. That's about right. That's about right. I used to think they were much better, and they might have been.
I think they were better in the 80s when I started going there.
Exactly. Everything was better back then. Financials. A 10 is a fortress. A 1 is yikes. Both of you have a 5, Travis.
Yeah, like I said, return on assets about 8.8%. They do have a pretty good net margin. That's because they've got pretty good brands. Owning a steakhouse is actually a pretty good business, pretty high margin. You can run through a lot of volume. You can spend a few $100s, as we were telling stories before we were taping about our expensive trips to some of these steakhouses. But I don't think you can go too high, because it's definitely not a fortress business. Like Matt said, it is very cyclical. If we go into some sort of recession this year or next, that's going to hit revenue, and that's going to hit margins as well. It's also not a terrible business. So again, just kind of middle of the road.
Yeah, I never understood how a business couldn't make a lot of money if they got people to pay $80 for a steak that they bought for $10 from a meat supplier. But there's a lot that goes into it. There's labor costs, there's the cost of the building itself, there's all the sides, there's supplies. There's a lot that goes into running a restaurant. I do respect that 9% net margin, because as a once upon a time restaurant manager myself, I know that's tough to do. The balance sheet's okay. I mean, $195 million in cash, $2.8 billion in debt. That's a reasonable debt load for a company of its size. So, nothing great, but nothing that would be a big red flag.
Yeah, we were talking before in our before taping, and we're all trying to kind of figure out. I mean, it's got a lot of brands, and it's unclear what advantage there is. There's certain things like financing or getting volume discounts and stuff, but versus like a Chipotle, which basically just has the one brand. We're not sure, but as you can see by the scores, we're not that impressed. Matt, let's talk about valuation. How well will Darden stock do over the next 5 years, and how safe is it, keeping in mind a 10 is a sure thing, a 1 is a lottery ticket?
Yeah, I kind of went through the safety before, but I'd say a 0 to 5% return over the next 5 years annualized, a 5 for safety. The valuation's a little high for a restaurant stock. I mean, given the margins, given the growth potential here, 23 times earnings is a little bit more than I'd be comfortable paying for it. If consumer spending holds up, this could be a mid-single digit returner. That's a big if in my book, given what's going on in the economy right now. People are pumping the brakes on spending, and we don't know what's going on with inflation and food costs and things like that. So safety scores a 5, and that may be a little generous.
Yeah, I went with this case. I was a little bit more bullish here, surprisingly enough. Safety score is 6 and an expected return of 5 to 10%. And that's basically a market return. Like Matt said, the 23 price to earnings multiple, if you look on a forward basis, is about 19. So I don't think that's a crazy price to pay, especially when you look at some other very, very highly valued restaurants. The one thing that I'll say, if we do go through some sort of downturn, a company that has this much diversity, this much real estate, this many brands, is going to be able to survive a lot better than its competitors. So it's going to be more the mom and pop shops, that are going to go out of business if we do have a big downturn. And then when you have a recovery, it's a company like Darden that's going to actually be able to benefit from that. But, still, I don't think you should have too high expectations here, especially given what we're paying.
Let's move on to everyone's favorite topic. Matt, is there a company in Darden space you like better?
Yeah, as far as restaurant stocks, I think my favorite is still Texas Roadhouse, TXRH. Similar valuation and profitability, similar, just similar business. Far better revenue growth. Their management's more aggressive and more innovative, and it's one that I like slightly better.
Yeah, values of the really good restaurants like Chipotle, Cava, kind of the ones that have really phenomenal economics are really stretched right now, even though some of those have pulled back a little bit. I'm going to stick with one I've talked about here, a little bit smaller, a little bit more value. That's Portillo's. Price to sales multiple is about 1 compared to Darden's price to sales multiple of about 3. They also have, remember the economies of scale, right? You have one brand, one thing that you're actually leveraging when you're doing your advertising, when you're buying your product, when you're negotiating your leases. So I think that's potentially an advantage, and they're expanding their footprint 10 to 15% a year. So I think you have that growth story, and it's kind of a more consistent growth story given that it is just one brand. So that's one that I like in the space a little better.
I own all 3 of the ones Travis mentioned, Chipotle, Cava, and Portillo's. Thank you to both Matt and to Travis. They've given Darden a low overall score of 5.2 out of 10. The high point was a 6 for management, so nothing really standing out there. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is MedPace. Till then, Fool on.
What's the advantage of all these brands being together?
You save a lot of money on salt. You can buy your salt for all the restaurants.
Is it like we get super cheap napkins?
I mean, there's operational efficiency.